All financial institutions face the risk that their liability holders will want their cash back. This includes us closing our checking accounts down. Or maybe we want to make a big purchase and decide to max out our credit card. Events like this put pressure on banks to come up with funds. These are commitments that banks must honor. Sometimes these commitments must be honored at very short notice. Our goal in this session is to understand how banks manage cash shortfalls. We will introduce the concept of liquidity risk. We will then discuss what banks can do about it, both in normal times and when they experience sudden and large surges in withdrawals. These surges are often called liquidity crises or bank runs. Risk is about uncertainty surrounding some future outcome. Liquidity risk is about cash shortfalls and how expensive they can be. At any point in time, there is cash flowing into the bank. This can be new deposits, investment returns, fee income, and at any point in time, cash can leave the bank. A cash shortfall occurs when there is more cash leaving the bank than flowing in. Sometimes these periods are cheap to handle. Perhaps banks can easily come up with cash. But sometimes these periods can be expensive. It really depends on the prevailing market conditions. Where could these cash shortfalls come from? We have already mentioned depositor withdrawals. I have the right to convert my checking account into cash at very short notice. Banks also rely on wholesale funding. This is short-term debt that may need to be renewed or rolled over on a regular basis. If investors become risk-averse, they may refuse to roll over the funding and instead demand their cash back. Credit commitments. This includes our credit cards, give borrowers the right to loans. This is cash that the bank must provide. Here is our simplified bank balance sheet. On the asset side, we have cash, securities, and loans. This adds up to $100 of investments. That $100 is funded by deposits, borrowing, and owner's equity. When credit cards are charged, cash goes out and loans are added to the balance sheet. When deposits are withdrawn, cash also goes out and debt is subtracted from the balance sheet. We can see these major sources of liquidity risk at JP Morgan Chase. This is the credit portfolio in 2020. Here are the undrawn loan commitments. They are about 50% of total loans outstanding. When these loans are drawn down, JP Morgan has to come up with the funds. And here is the funding side of the balance sheet. Borrowed funds are a meaningful source of finance for JP Morgan. This borrowing can be done on a short-term basis. This exposes the bank to rollover risk. These withdrawals are fairly predictable in normal times. This allows banks to manage liquidity risk without too much difficulty. Banks use two approaches to handle withdrawals. The first is called asset management. Here, banks use cash reserves to handle cash shortfalls. The second method is called liability management. In this case, banks do some short-term borrowing to plug the gap. Let's see how this works when our simplified bank has a deposit withdrawal. Suppose $10 is pulled out. Deposits decline from $70 to $60. The bank has lost $10 of funding. With asset management, the bank simply hands over its cash to meet the withdrawal. $10 of cash is gone. Bank assets shrink down to $90 as well. Of course, the bank could also achieve the same outcome by selling its liquid securities. This is another response coming from the asset side of the balance sheet. Instead of selling assets, the bank could raise additional funds. The bank could replace the $10 of deposit withdrawals with another $10 of debt. To meet this shortfall, the bank could borrow from another depositor or another financial institution. This is called liability management. In normal times, these two methods usually work out well and they allow banks to manage their cash shortfalls. However, there are times when banks can face a liquidity crisis. This is when cash shortfalls are much larger than expected. Liability holders can withdraw their funds all at once. This is called a bank run. This most often happens when investors lose confidence in the bank. As a result, the usual liquidity management tools can fail or become more expensive. For example, banks might be shut out of money markets. On the asset side, once cash reserves are gone, banks might be forced to dump their loans and other less liquid assets at unfair prices. This is called a fire sale. Here is an example of a fire sale starting in late February 2020. These are the prices of business loans that trade in financial markets. We can see the rapid drop-off and rebound in the price of these loans. If a bank has to sell business loans at the bottom to meet a funding shortfall, that's going to be very costly. If a bank is not well prepared for a liquidity crisis, then it could become insolvent. Its equity could get wiped out. Let's see how this works when our simple bank experiences a run. Okay, here is our bank. Let's assume that some depositors and debt holders run. $20 of deposits run away, and all of the borrowed funds are gone. Overall, $40 is gone. This is the cash shortfall. Our bank is in trouble, so let's assume that it is shut out from borrowing. Liability management is not going to work. Our bank has some cash and securities. We can hand that over right away. That's $25. The remaining $15 will have to come from selling loans. The bank has no other choice. Loans are not easy to trade because they're information sensitive. Potential buyers face adverse selection risk and demand a sizable discount. Our bank has to sell $20 of loans in order to raise the $15 that it needs. In the end, we have our $40 in cash. Over it goes, and our run is over. What were the costs of scrambling for cash? Well, the bank sold $20 of loans at a loss of $5. That's a $5 loss that the owners have to bear. This leaves the bank with only $5 of equity. Here is our bank at the end of this process. It is a smaller bank, and the shareholders have less equity, but it survived. If our bank had carried more cash or used less wholesale funding, then it might be in better shape. Taking a step back, we can see that cash shortfalls have an impact on equity values. In the extreme, they can wipe out shareholders and cause a bank to fail. Let's wrap up. In this session, we introduced the concept of liquidity risk. All banks have to deal with cash shortflows. They can use methods that stem from the asset or the liability side of the balance sheet. Banks that carry lots of cash or have access to stable funding are more resilient. These banks are better positioned to handle liquidity crises.